In the summer of 1720, the share price of a single London company rose by roughly 700% in 6 months. Then, over the next 10 weeks, it lost almost everything it had gained. Aristocrats were ruined. A bishop hanged himself. Isaac Newton, the greatest mathematician alive, lost about £20,000, an amount equivalent to several million in modern money. When asked later if he could predict the markets, Newton reportedly said he could calculate the motion of the heavenly bodies, but not the madness of men. He was talking about the South Sea Company. The South Sea Bubble is one of those episodes that gets reduced in textbooks to a tidy moral lesson. Investors went mad, then the bubble popped, then everyone learned never to do it again. None of that is quite right. What actually happened in 1720 was the first time a modern state used a private joint stock company to refinance its national debt, and the first time that maneuver collapsed into a public political scandal. Out of that collapse came the regulatory architecture of modern finance, the Bubble Act, the rise of Robert Walpole as Britain's first effective prime minister, and a cautious British capital market that would dominate the next 2 centuries. Let's walk through how England invented the modern financial crisis. First, the level set. The South Sea Bubble was not an accident. It was a solution to a problem the British state did not know how to solve any other way. The problem was war debt between 1689 and 1713. Britain was at war with Louis XVI's France almost continuously. The 9 Years' War and then the War of the Spanish Succession ate enormous sums. By the Treaty of Utrecht in 1713, the British national debt had grown from roughly £2 million before the wars to nearly £40 million afterward. At the prevailing interest rates of 6 to 8%, simply servicing this debt was eating around half the entire annual government revenue. Now, in 1713, the British Treasury had 3 options. 1. Raise taxes. Politically toxic in a country where Parliament jealously guarded taxpayer revolts. 2. Default on the debt, catastrophic for British credit in the still young European bond markets. 3. Find a way to convert the high-interest, illiquid government debt into something cheaper to service. Option 3 is what they chose. The mechanism they invented to do it was called debt for equity conversion. Here is how it worked. In concept, the government would charter a private company. The company would offer its shares to existing government creditors in exchange for their bonds. The creditors would surrender their high-interest annuities and receive shares of a company that the government promised would generate enough revenue from its commercial monopoly to pay them a reliable dividend. In exchange for taking on this conversion, the company would be granted an enormously valuable monopoly, trading rights to the Spanish colonies in South America. In 1711, Robert Harley, the Earl of Oxford and Lord Treasurer, founded the South Sea Company on exactly this premise. The company absorbed roughly £9 million of government debt in its first conversion. The shareholders got an annual 6% dividend backed by treasury duties. The Spanish trade monopoly looked golden on paper. But here was the catch. Spain still controlled South America. Britain had no actual permission to trade there, beyond a narrow concession negotiated at Utrecht, the Asiento, which allowed Britain to send 1 ship per year of merchandise plus an annual cargo of slaves. 1 ship per year. In other words, the company was a vast financial vehicle for absorbing government debt, attached to a tiny commercial operation that generated almost no real earnings. For about 8 years, this contradiction was hidden by the fact that the shares paid a steady dividend out of treasury allowances. In early 1720, the directors of the South Sea Company made a proposal that would attempt to absorb the entire remaining national debt, roughly £30 million, into the company in a single grand conversion. And to make the offer attractive, they needed the share price to go up. Now, the mechanics, because the South Sea Bubble was not a spontaneous mania. It was engineered. The conversion offer worked like this. The South Sea Company would offer to swap its shares for outstanding government bonds at the current market price of the shares. If a share was trading at £100, a creditor with £100 in bonds could exchange those bonds for one share. If the share was trading at £300, the same £100 of bonds would only get the creditor 1/3 of a share. In other words, the higher the share price, the fewer shares the company had to issue to absorb a given amount of debt, which meant that the higher the share price went, the more free shares the company had left over that it could sell on the open market to raise cash. Cash that the directors and their political allies could pocket as profit. This created a powerful incentive. The directors did not just need the share price to rise during the conversion, they wanted it to rise as fast as possible. So they used 5 techniques, all of which would later become standard tools of financial mania and financial fraud. Technique 1, aggressive marketing of the trade monopoly. Pamphlets were printed, distributed in coffee houses, planted with friendly newspapers. They described the imminent riches that would flow from the South American trade once Spain inevitably granted broader access. Almost none of it was true. Technique 2, bribery of politicians, court officials, and the royal mistresses. The South Sea Company gave hundreds of thousands of pounds worth of shares to the king's mistresses, to senior ministers, to members of parliament on what were called fictitious accounts, meaning the recipient never paid for the shares but would receive any profit when they rose. In exchange, these influential figures became loud public boosters of the company. When a duchess told her dinner guests that the shares were going up, the dinner guests believed it. Technique 3, loans to buy more shares. The South Sea Company itself and other intermediaries began offering loans to investors so they could purchase additional shares using their existing shares as collateral. This is the 18th century version of buying on margin. When the share price was rising, investors could double their position with borrowed money. The leverage made gains accelerate. The leverage would also, of course, make losses accelerate. Technique 4, restriction of supply. The directors timed share offerings carefully, holding back inventory, releasing new tranches, only at progressively higher prices. Each new subscription was at a higher price than the previous one, and each was oversubscribed. By manipulating the supply, they manufactured the appearance of relentless upward demand. Technique 5, political bundling. In April of 1720, Parliament passed the South Sea Act, which authorized the company to absorb the remaining national debt. The bill was rushed through with the personal lobbying of ministers who held undisclosed company shares. When Parliament endorsed the company by statute, the public read it as a government guarantee. That was the most dangerous misconception of all. The combination of these 5 techniques drove the share price from roughly £128 in January of 1720 to a peak of £1,050 at the end of June. Roughly an 8-fold increase in 6 months. During the same period, the company's actual commercial business, the 1 ship per year to Buenos Aires, was largely unchanged. In late June of 1720, several events combined to break the spell. Event 1. The directors, sensing that the price could not rise further, began quietly selling their own shares while continuing to talk publicly about the company's prospect. By July, large blocks were being sold by insiders who knew the underlying business could not justify the valuation. In modern terms, this is the precise definition of insider trading and securities fraud. In 1720, it was simply how the directors behaved when they thought the peak had arrived. Event 2. The Bubble Act of June 1720. In a curious twist, Parliament passed an act that summer designed to restrict the formation of new joint stock companies without royal charter. The South Sea Company itself had lobbied for this law, intending to suppress the rush of imitator schemes, the bubbles of the bubble's name that had sprung up alongside it. But the act backfired. When the Crown began enforcing it in August, dozens of speculative companies collapsed simultaneously, triggering a cascade of margin calls across the London market. Investors who had borrowed against South Sea shares to fund their positions in other bubbles were forced to sell South Sea shares to cover their losses. Event 3: confidence broke. By the end of August, the South Sea share price had slipped from its June peak of around £1,000 to roughly 800. By mid-September, it was below 500. By the end of September, it was below 200. By December, it was back to roughly £128. The same price it had started the year. The damage was distributed in distinctive layers. Aristocrats and wealthy gentry had bought heavily at the top, often on margin, often with borrowed political prestige attached. They lost the most in absolute pounds. Members of the merchant class who had bought earlier and sold during the rise made fortunes. But many of them turned around and bought back near the peak and lost most of their gains. Small investors who had borrowed against modest assets to buy shares in the spring tranches were wiped out. Several committed suicide. One notable casualty was John Islaby, the Chancellor of the Exchequer himself, who had personally profited from inside knowledge of the company. He was expelled from Parliament and briefly imprisoned in the Tower of London. By the time Parliament was recalled in December of 1720, the political question was no longer whether to investigate the company. The question was how broad and how deep the investigation would be. A secret committee was established with subpoena power to examine the company's books. What it found was, by the standards of the time, scandalous. The committee discovered the fictitious shares given to politicians and court figures. It traced the bribes to specific ministers. It found 2 of the king's mistresses listed as recipients of free shares. It found that the directors had been falsifying entries in the company's official books, that bribes had been paid out of the company treasury, and that several directors had fled the country with their fortunes. One director, Robert Knight, the company's cashier, escaped to the Spanish Netherlands carrying critical evidence with him. The British government's request to extradite him was deliberately delayed by sympathetic ministers, because Knight's evidence would have implicated even more senior figures than the ones already exposed. The figure who emerged from this disaster was a politician named Robert Walpole. Walpole had been First Lord of the Treasury before the bubble and had publicly opposed the South Sea scheme on its merits. He had also, more quietly, made significant personal profits speculating in South Sea shares during the rise and managed to sell most of his holdings before the collapse. When the crisis hit, the king and the ministry needed someone of his stature, his perceived competence, and his lack of fingerprints on the worst of the corruption to manage the politics. In April of 1721, Walpole returned to office as First Lord of the Treasury and Chancellor of the Exchequer, the role we would later recognize as the position of Prime Minister. Walpole's response to the bubble defined modern British political economy in 3 ways. 1. Restitution without total prosecution. Walpole engineered a financial restitution scheme in which the estates of the disgraced directors were confiscated and distributed pro rata to ruined investors. The directors themselves were largely allowed to live out their days in disgrace rather than at the gallows. This calmed public anger without precipitating a full revolutionary crisis among the political class. It also conveniently kept the further investigations narrow. 2. He shielded the senior politicians, including some royal favorites, from prosecution. This is where Walpole earned his nickname, the Screen. By preventing the worst revelations from coming out, he protected the Whig political establishment, the Hanoverian dynasty, and indirectly himself. He also created a durable political coalition that would dominate British politics for the next 2 decades. His critics would call him cynical. His defenders would call him pragmatic. Both labels were accurate. 3. He stabilized the financial system. The Bank of England, founded in 1694 but still institutionally young, was strengthened. The remaining debt was renegotiated at lower interest rates. The South Sea Company itself, stripped of its grand pretensions, was kept alive as a dull annuity, issuing entity that paid modest interest for another century. Walpole's overall message to the markets and to the continent was, Britain pays its debts. Britain does not default. Britain's financial system can absorb a major shock and continue functioning. This was, in retrospect, the most important consequence. Britain's reputation as a reliable sovereign borrower survived the South Sea bubble. Over the next century, British government bonds, the famous consols, became the safest and most liquid financial instrument in the world. London replaced Amsterdam as the world's financial center. The Industrial Revolution was financed in significant part by the deep, cheap, trusted British capital markets that emerged in the decades after the bubble. Pull back further, the downstream consequences of the South Sea bubble shaped the next 3 centuries of finance. Consequence 1, the Bubble Act of 1720 remained on the books for over a century until it was repealed in 1825. During those 105 years, it was effectively illegal to form most types of joint stock company in Britain without specific royal charter or parliamentary act. This restricted the development of British corporate finance, paradoxically channeling capital into government bonds, partnerships, and a smaller number of carefully chartered enterprises like the East India Company. When the act was finally repealed, and especially after the Joint Stock Companies Act of 1844, the British corporate sector exploded. But it did so under regulatory frameworks that had been shaped scar by the lessons of 1720. Consequence 2. A culture of caution in British public finance. After 1720, no British government attempted to convert public debt through a private commercial vehicle on anything like the same scale. Instead, debt was managed through the Bank of England, through transparent and gradual conversions, through long-dated, low-coupon consols. When Britain needed to raise war finance for the Napoleonic Wars at the start of the 19th century, the system worked. When it needed to raise finance for 2 world wars in the 20th century, the system worked again. The bubble had taught the British state a permanent lesson. Do not let the public finances become entangled with a single private equity speculation. Consequence 3, the vocabulary and the playbook. Almost every modern financial bubble follows the same pattern that the South Sea Company set in 1720. An underlying real opportunity, often modest. An aggressive marketing campaign, political endorsement that the public mistakes for a guarantee, leverage and margin lending that accelerate the rise, insider selling near the top, a trigger event that breaks confidence, a cascade of forced selling, a scramble for scapegoats, a regulatory response that overshoots in one direction or another. We have seen this pattern in the 1929 stock market crash, in the 1989 Japanese asset bubble, in the 2000 dot-com bust, in the 2008 mortgage crisis, in the recent waves of crypto asset cycles. All of them, in their bones, are descendants of the South Sea Company. The mechanism was prototyped on Exchange Alley in 1720, and it has been running with variations ever since. Consequence 4. Isaac Newton's lesson. Newton had bought South Sea shares early, sold near the spring of 1720 for a tidy profit, then bought back at much higher prices in June and held into the crash. He lost the modern equivalent of several million pounds. His apocryphal remark that he could calculate the motions of the heavenly bodies, but not the madness of men, capture something durable. Markets are not solved problems. The smartest individual you can imagine, applying the most sophisticated tools of his day, can still lose his fortune in a bubble. Because the question is not whether the math works. The question is when the crowd decides it does not. And no equation forecasts that. So what does the South Sea bubble teach? First, state debt is a problem with no good answers, only trade-offs. The British state in 1720 faced a real fiscal crisis. The South Sea conversion was a clever attempt to solve it. The clever attempt collapsed because the political incentives of the people running the scheme overwhelmed their fiduciary duty to the public. Every modern attempt to manage sovereign debt through complex financial engineering faces the same temptation and the same failure mode. Second, regulation lags reality and then overshoots. The Bubble Act of 1720 was passed by the same parliament that had just authorized the South Sea conversion. It hampered British corporate development for over a century. Almost every post-crisis financial regulation in modern history follows the same shape: too little, too late, then suddenly too much, persisting too long. The legal architecture you live under was built by the panics of your great-grandparents. Third, reputation is the most durable asset a financial system has. The British state survived the South Sea bubble because it chose to honor its obligations, prosecute its worst offenders, and pay its remaining debts. That decision, more than any specific reform, is what allowed London to become the financial capital of the modern world. Nations that default rebuild slowly. Nations that pay, however painfully, compound advantages over centuries. In the summer of 1720, the share price of a single London company rose by 700%. In the autumn of 1720, it gave nearly all of it back. Aristocrats were ruined. A bishop hanged himself. A great mathematician lost a fortune. A clever financier fled abroad with the incriminating books. A pragmatic, slightly compromised politician named Robert Walpole stepped in, calmed the politics, paid down the debt, and shaped the British state for the next 20 years. The South Sea bubble looks on first glance like a moral tale about greed. It is really a structural tale about institutions. Where the institutions were weak, fraud filled the gap. Where the political class had personal exposure, oversight failed. Where the law had not yet caught up to the financial instruments, the public was vulnerable. Each of these gaps was very slowly partially closed in the decades after 1720. Each of them, in some form, has reopened in our own time. The most important habit you can take from this episode is not to look at modern markets and ask, is there a bubble? It is to look at modern institutions and ask, are the gaps the same ones? If you want more episodes that follow the long causal chain from crisis to consequence, subscribe. There is a lot of history to explain